Hello everyone, welcome to my channel. Today I'm going to talk about getting married soon, tax issues to think about. Let's get into the video. You think planning a wedding ceremony is complicated? Wait till you see the possible tax issues involved. If you are getting married this year, there is a long list of things you need to be aware of and plan for before tying the knot that can have a significant impact on your taxes. And there are a number of tax related actions you should take as soon as possible after marriage. Considerations before marriage. The first thing is filing status. For tax purposes, an individual's filing status is determined on the last day of the tax year. First, regardless of when you get married during the year, you and your new spouse will be treated as married for the entire year and therefore can no longer file as single individuals or use the head of household status as you may have done prior to this marriage. Your options are to file using the married joint status, combining your incomes and allowed deductions on one return, or to file two separate returns using the married filing separate status. The latter is not the same as the single status you may have used in the past and can include some negative tax implications. Filing separately in common community property states like Arizona, California, Idaho, Louisiana, Nevada, New Mexico, Texas, Washington, or Wisconsin can additionally be complicated. Also, the terms of a prenuptial agreement, if you have one, can affect your filing status choice. Deductions. The standard deduction for each year is inflation adjusted, and for 2023, for a married couple, is 27,700, and for a single individual is 13,850. So if both of you have been filing as single and taking the standard deduction, there is no loss in deductions. However, if in past years one of you had enough deductions to itemize and the other took the standard deduction after marriage, you would either have to take the joint standard deduction or itemize, which might result in a loss of some amount of deductions. There could also be an overall reduction of the standard deduction if one or both of you previously filed as head of household. Thirdly, the new spouse pass liabilities. If your new spouse owes back taxes, past state income tax liabilities, or past due child support, or has unemployment income debts to a state, the IRS will apply your future joint refunds to pay those debts. If you are not responsible for your spouse's debt, you are entitled to request your portion of the refund back from the IRS by filing an injured spouse allocation form. Fourthly, combining incomes. Combining your incomes can push your taxable income into a higher tax bracket than when filing separately, resulting in a significantly higher income tax. The combined higher incomes can also cause you to lose certain tax benefits available to individuals in lower tax brackets, such as the child tax credit, which begins to phase out when your combined income, which is the MAGI, reach 400,000. The child care credit, if either or both of you have a child and you both work, because a lower percentage of expenses applies as income increases, and the possible loss or reduction of the earned income tax credit, which applies to lower income individuals. Next, healthcare insurance. If either or both of you are obtaining health insurance through a government marketplace, your combined income and change in family size could reduce the amount of premium tax credit to which you would otherwise be entitled, requiring payback of some or all of the credit applied and in advance to reduce your monthly premiums. More complicated yet, if either or both of you are included on your parents' marketplace policy, those insurance premiums must be allocated from the parent's return to your return. Sixth thing is spousal IRA. Spousal IRAs are available for married taxpayers who file jointly where one spouse has little or no compensation. The deduction is limited to the smaller of 100% of the employed spouse compensation or 6,500 2023 for the spousal IRA. That permits a combined annual IRA contribution limit of up to 13,000 for 2023. For each spouse aged 50 or older, the maximum increase by 1,000. However, the deduction for contributions to both spouses' IRAs may be limited if either spouse is covered by an employer's retirement plan. Seventh thing is capital loss limitations. When filing as unmarried, each individual can deduct up to 3,000 of capital loss on their tax return for a possible combined total of 6,000. But as a married couple, is limited to a single 3,000. Next is the impact on parents' returns. If your parents have been claiming either of you as a dependent, they will generally lose that benefit. In addition, if you are in college and qualify for one of the educational credits, those credits are only available on the return where your dependency applies. That generally means your parents will not be able to claim the educational credit even if they paid the tuition. Here are things to take care of after marriage. 1. Notify the Social Security Administration. Report any name change to the Social Security Administration so that your name and Social Security number will match when you file your next tax return. Informing the Social Security of a name change is quite simply. The Social Security Administration provides an online site to accomplish this task. Your income tax refund may be delayed if it is discovered that your name and Social Security number do not match at the time your return is filed. Another thing to take care of after marriage is notify the IRS. If you have a new address, you should notify the IRS by sending Form 8822, change of address. Another thing is notify the U.S. Postal Service. You should also notify the U.S. Postal Service when you move so that any IRS or state tax agency correspondence can be forwarded. The fourth thing to take care of after marriage is review your withholding and estimated tax payments. If both you and your new spouse work, your combined income may place you in a higher tax bracket, and you may have an unpleasant surprise when preparing your return for the first year of your marriage. On the other hand, if only one of you works, filing jointly with your new spouse can provide a significant tax benefit, enabling you to reduce your withholding or estimated payments. In either case, it may be appropriate to review your withholdings, W-4 status, and estimated tax payments, if any, to make sure that you are not going to be under withheld and that you do not set yourself up to receive bad news for the next filing season. The IRS provides a W-4 webpage that provides links to the form and a tax withholding calculator. The fifth thing is notify the marketplace. If you or your spouse has purchased health insurance through a government marketplace, you must notify the marketplace of your change in marital status. If you were included on a parent's health insurance policy through a marketplace, then the parent must notify the marketplace. Failure to notify the marketplace can create tax filing problems. Thanks for watching this video, and do not forget to subscribe to my channel.